Welcome to The Explainer. Today, we are breaking down the new Trump account. It's a brand new savings plan that could give your child a huge head start with over $1,000 of, yes, free money. But, and this is a big but, there's a hidden tax trap that could end up costing you more than you put in. So, let's get into it. So, first things first, what are these Trump accounts? You've probably seen the name floating around, and there's a lot of buzz. Let's cut through the noise and figure out how they actually work. And really, this is the number that matters. How can this new account put $1,250 into a savings account for your child, totally free, without you having to contribute a single dime? Okay, probably the easiest way to think about this is like an IRA for kids. It's a really powerful savings idea, but it operates under a very unique, very specific set of rules that you absolutely have to understand. So if we're going to get official, the technical name is an IRC Section 530A account. The goal is simple, right? To create a tax-friendly way to build up a nice little nest egg for a child. And while it feels a lot like a regular IRA, the fact that it's designed just for kids is where all the special features and, the potential problems start to pop up. All right, let's talk about the part that gets everyone excited, the quote-unquote free money. And this is really important. This isn't about your contributions. We're talking about seed money from other places that's available right from day one. This starting money comes from two completely separate places. And here's the key. Neither of them is you. We're talking about a government pilot program and private charitable foundations. This is why it's not considered a gift from you. First up, there's a pilot program from the U.S. Treasury, and it's putting $1,000 into the accounts of eligible children who are born between 2025 and 2028. That's a direct investment from the government into your kid's future. And then, on top of that, you got these big charitable groups, like the Michael Dell Foundation, who are jumping in. They're adding another $250 to these accounts. So you add it all up, and that's a $1,250 head start before you've done a thing. And the best part? Because this money isn't from you, you don't have to deal with any complicated gift tax forms. It's just clean, simple. But look, that initial $1,250, that's just planting the seed. The real magic, the real power, comes from what happens next. Just letting that money sit there and grow for the next 18 years. And this is where you really see the power of time. If you assume a pretty standard 8% annual return, that initial seed money could balloon to almost $5,000 by the time your child becomes a legal adult. I mean, think about that. That's a 300% gain on money you never even had to contribute in the first place. Okay, so that all sounds amazing, right? But now we have to talk about the catch. And this is where things get really, really tricky. This is the part every parent needs to understand before they even think about adding their own money to the pot. I mean, it seems like such a great idea. You've got this awesome savings account going for your kid. Why wouldn't you want to add a couple $100 yourself to help it grow even faster? What could possibly be the problem? Well, it all boils down to this weird little corner of tax law called a gift of a future interest. See, because the rules say your child can't actually touch or use this money until they're 18, any money you put in isn't seen as an immediate gift. It's a gift for the future. And this right here is the whole problem in a nutshell. You've got two types of money going into one account, but they're playing by two totally different rule books. The free seed money, simple, no strings attached for you. But the second you add your own cash, you're suddenly in a whole different, much more complicated tax situation. You know how you can normally give someone up to $19,000 a year without having to tell the IRS? That's called the annual gift exclusion. Well, because your contribution is considered a future interest, that entire rule just goes right out the window. It doesn't apply at all, which means technically, even if you put in one single dollar, it has to be reported. And it gets a little absurd. As one tax expert pointed out, if you really want to contribute, say, $500, you have to realize you'll probably end up paying your accountant more than $500 just to prepare the required tax form, Form 709. It's a trap that could cost you more than your gift. So, with this amazing opportunity on one side and this really nasty risk on the other, what's the smart move? What's the clear, expert-recommended plan for parents right now? Okay, here's the game plan, and it's actually really simple. Tax professionals all agree. It's a two-step process. Step 1, absolutely 100% sign up and get that free seed money. Step 2, and this is the crucial part, wait. Do not add any of your own money yet. Wait until the IRS clarifies these rules. Now, the official way you do this, the piece of paper involved, is IRS Form 4547. It's called the Trump account election. This is the form that gets the account set up for your child and puts them in line for that free money. So let's just boil it all down to this one key takeaway because it's the most important thing to remember. You need to separate these two decisions. The decision to open the account, you should do that now to lock in these benefits. But the decision to personally fund it, that's a decision you put on hold until the tax rules are crystal clear. And all of this leaves us with one final big question. The whole point of this program is to help families save for their kids' futures, right? But you have to wonder, did they accidentally make it so complicated that the tax rules will get in the way of the very people it's supposed to help? It's definitely something we'll be watching.